What if the money in your pocket could actually decide what you're allowed to buy and, when you have to spend it?
It sounds like science fiction, right? But it's definitely not.
No, it's really not. And well, welcome to today's deep dive, everyone. We are jumping into some seriously intense territory today.
Yeah, we really are.
We're unpacking this single, very provocative source. It's a manifesto in a book titled The Sovereign Exit: Surviving the Age of Programmable Money.
Which is quite the title.
Right. And our mission today is to unpack the author's stark warning about this upcoming 2026 rollout of retail central bank digital currencies.
Or CBDCs, as they're usually called.
Exactly, CBDCs. We're going to explore this really intricate roadmap they've laid out for what they're calling financial survival.
Yeah, and I mean, it is a dense, highly urgent text. It outlines this massive fundamental shift in how society literally interacts with value itself.
Value itself, yeah.
Because the author argues that we are standing at this absolute tipping point in monetary history,
Right.
like a moment where the foundational rules of economics are just being rewritten in real time.
Right. Now, real quick, before we get into the actual mechanics of all this, we definitely need to set the stage for you listening.
Absolutely.
Because the claims in this book, they are highly charged. I mean, they deal with mass surveillance, central banking, government control, all that heavy stuff.
Very heavy themes.
Yeah. So we just want to be crystal clear. We are not here today to endorse these politics or pick a side or stoke fear or anything like that.
Right. Our job isn't to tell you what to believe.
Exactly.
Huh.
Our goal as your guides is strictly just to look at the architecture of the technology that the author is warning about. We're just impartially breaking down the arguments so you can understand the concepts for yourself.
And that distinction is really vital, I think. We're analyzing the technological infrastructure that's presented in the text and, the systemic implications of that infrastructure, totally, regardless of where anyone stands on the political spectrum.
Okay, so let's unpack this. Because to understand this exit strategy the author is pushing, we first have to wrap our heads around what they believe actually died this year.
Yeah, and what died, according to the text anyway, is the whole concept of neutral money.
Neutral money, which is tied to this 2026 CBDC rollout, right?
Right. The foundation of the author's entire thesis really rests on the idea that private, anonymous physical cash is just over. It's done.
Wow.
Because think about it. For centuries, money was fundamentally a bearer instrument.
Meaning whoever holds it owns it.
Exactly. If you had the physical dollar bill or a gold coin in your hand, you possess the purchasing power. The instrument itself was totally neutral.
Right. The cash didn't care who you were.
No, it didn't know your identity. It didn't factor in your political affiliations. And it definitely didn't calculate your carbon footprint.
Okay, let's ground that for a second for the listener. Say I go to a local farmer's market, right?
Okay, nice and simple.
Yeah, and I hand a $20 bill to a vendor for, I don't know, a box of strawberries.
Right.
That transaction clears instantly.
Fine.
There's no server anywhere checking my credit score. There's no database recording that I bought fruit instead of, vegetables.
Yeah, no data trail at all.
Yeah, the paper bill itself is the value. It creates zero data trail.
And that lack of a data trail is the absolute core of neutrality. But the text argues that with these programmable retail CBDCs coming in 2026, that era is officially closed.
It's gone.
It's gone. And the author introduces this concept, they call it programmed friction.
Programmed friction. Okay, what does that actually mean?
Well, it means we are moving from a system of, math and paper to this digital ledger where the central authorities issuing the currency can actually throttle it.
Throttle it, slow it down.
Or dynamically restrict certain purchases based on real-time social or environmental metrics.
Okay, I want to walk through a day in the life under this proposed system because that is a massive conceptual leap.
It really is.
Let's say I go to the grocery store to buy a steak. Under this model of programmed friction, what actually happens when I try to pay?
Well, according to the mechanics laid out in the text, when you tap your digital wallet, the transaction doesn't just, check if you have sufficient funds in your bank account.
What else is it doing?
The ledger simultaneously queries an external database. So maybe it's a central environmental API, right?
Okay.
And it checks your carbon allowance for the month.
Oh, wow.
Yeah. And if the system sees that you are over your allocated limit for high-emission foods, the smart contract that governs the currency introduces that friction we talked about.
So what does that look like at the register?
The transaction is either just outright declined right there or an automatic punitive environmental tax is instantly deducted from your balance.
That's wild. So the money is sitting right there in my account. I can see it, but the code literally decides I'm not allowed to buy beef today.
Exactly. The author highlights this as a profound psychological shift for society
I can imagine.
because we're no longer talking about owning currency in the traditional sense.
Yeah.
The whole paradigm has moved to a system where you merely hold a conditional license to spend.
A conditional license to spend. I mean, that is a chilling phrase.
It really reframes everything.
It's as if it's like you think you own your car outright, right? But the dealership actually holds a remote control.
Oh, that's a good way to put it.
Yeah, and they can tap the brakes or just cut the engine entirely remotely if they decide they don't like where you're driving.
Yeah, you possess the physical vehicle, but they possess the ultimate authority over its utility.
Man. So mechanically, how does this text say a conditional license to spend alters the day-to-day experience of the consumer?
Well, it fundamentally strips away predictability. Because if your money is just a conditional license, its value and its utility fluctuate based on these external compliance algorithms.
So it's not stable.
No, not at all. You might have, say, 1,000 digital dollars in your wallet on Monday. But if your real-time metrics fall out of the acceptable range by Wednesday,
My permission is gone.
right, your permission to use those dollars on certain goods is just algorithmically revoked.
That is okay. So if my money can be throttled based on what I'm buying and my compliance metrics, the system has to know exactly where I am and what I'm doing at all times, right?
Yes.
So how are these invisible boundaries actually enforced in the real world?
The author describes this through the spatial and temporal control of money. They call these the invisible walls of algorithmic ledgers.
Invisible walls.
Yeah, and the text details two very specific tools here. The first one is geofencing.
Okay, I've heard of geofencing with apps, but how does it work with money?
This is where central banks actually program the ledger to restrict spending with specific zip codes or maybe exclusively to authorized vendor IDs.
Meaning the money only functions if my smartphone's GPS or the merchant's terminal actually registers that I am standing inside a designated geographic box.
Precisely. The mechanics rely heavily on that integration of location data and point-of-sale systems.
So I can't just spend my money wherever I want.
No. And the text argues this could initially be deployed under the guise of, like, managing regional economies.
Okay, give me an example.
Imagine a government issuing digital stimulus funds to citizens of a struggling town, right?
Sure, happens all the time.
But they program the currency so it can only be processed by vendors registered within that specific town's borders.
Oh, I see. To force local economic stimulation.
Exactly.
I mean, that sounds kind of beneficial on the surface, honestly.
Right, but the author views this as a profound restriction of movement. You are essentially trapped within a financial perimeter.
Yeah, that makes sense. You can't take that stimulus and spend it on a road trip. Okay, so geofencing controls where I can spend. But earlier you mentioned temporal control, like a loss of predictability over time. Is the author saying they can control when I spend it too?
Yes. And that brings us to the second tool, which is artificial expiration.
Artificial expiration.
The text points to the emergence of these use it or lose it expiration dates that are programmed directly into the digital currency itself.
Wow. Actually, I want to read the exact dystopian warning from the text here because I think it captures the emotion of this argument perfectly.
Go for it.
So the author writes, imagine waking up to find your hard-earned savings have an expiration date or your money won't work because you traveled outside a pre-approved zone. Central banks are no longer just printing currency. They are programming it to control your behavior through algorithmic surveillance.
It's an incredibly stark image, and it challenges the primary functions of money entirely.
Right, because money has to be a store of value.
Historically, yes. It must serve as a medium of exchange and a store of value. But if a digital wage credit has a self-destruct timer embedded in its code,
Then the store of value function is just destroyed.
totally destroyed.
Yeah.
You physically cannot save it for the future.
This transforms money from a global medium of exchange into what the author explicitly calls a localized tool for behavioral control.
That's the exact phrase, yeah.
It's like turning your life savings into a digital store coupon that expires on Tuesday
It forces artificial consumption.
because you have to spend the funds before the ledger burns them.
Exactly. Now, if we connect this to the bigger picture, the enforcement of all these invisible walls, it requires a massive underlying data architecture.
Right. It can't just happen in a vacuum.
No. And the author calls this the permission layer And I'll say, this is where the text's warnings reach their most severe pitch.
Here's where it gets really interesting, I think, because for a geofence or carbon tax friction to work, the ledger can't just be tracking a generic digital coin, right?
No, it can't.
It has to know exactly who is holding it.
Yes. The permission layer is the total seamless integration of your personal digital identity with these programmable ledgers.
Total integration.
Total. So your digital ID, your passport, your tax records, your biometrics, and your financial footprint, they are all fused into a single monitorable profile.
And the text argues this integration enables something called smart contract enforcement.
Yes.
So walk me through the mechanics of that, because the author draws a huge, huge distinction between this and our traditional legal system.
Well, think about a traditional system. If someone evades taxes or commits a financial crime, the state has to follow due process, right?
Right. They can't just take your money.
Exactly. The government investigates, they present evidence to a judge, they obtain a court order.
It takes a lot of time.
It takes time, it takes human oversight, and it takes legal friction. And then they serve that physical order to a bank, instructing a human bank manager to freeze the assets.
Right. But a smart contract is totally different. It's just an if-then statement written in code on a blockchain.
Right. And the author warns that in the CBDC system with a permission layer, that code literally replaces the gavel.
Replaces the judge entirely.
Completely. Political or social noncompliance results in the immediate automated freezing of assets.
Wow.
If the central algorithm determines your digital identity has violated a parameter, maybe you attended an unsanctioned protest or you posted some flagged content.
The smart contract just executes instantly.
Instantly.
So no court order, no judge, no human intervention whatsoever, just an immediate loss of purchasing power.
That's what the text is warning about, yes.
The text actually uses the phrase automated freezing without a court order.
Right.
What does the author say is the ultimate danger of this kind of algorithmic surveillance? Because they refer to this as a countdown to zero.
Well, they do. And the ultimate danger, as framed in this manifesto, is total systemic capture.
Total capture.
Think about it. If your ability to feed your family, buy medicine, or pay your rent is governed by an algorithm that demands perfect political or social compliance,
Then dissent becomes physically impossible.
exactly. You can't organize, you can't protest, and you really can't meaningfully disagree with the central authority.
Because the millisecond you do, the smart contract freezes your wallet.
Right. The countdown to zero is the countdown to the total loss of financial autonomy.
Yeah.
The author argues that if you rely on a programmable ledger controlled by a central authority, your freedom is already terminal.
Okay, so we've thoroughly mapped out the dystopian problem as the author sees it. Neutral money is dead. We're trapped behind invisible geofences. Our savings expire to force consumption. And a digital permission layer threatens to automatically freeze our lives if we step out of line.
It's a grim picture.
Very grim. But the author doesn't just point out the fire, right? They claim to have a blueprint for a fire escape.
They do. And the text frames the solution as the sovereign exit.
The sovereign exit.
Right. Having laid out all the vulnerabilities of these centralized kill switches, the author pivots to the absolute necessity of decentralized self-sovereign assets.
As the only viable countermeasure.
Exactly.
Okay, so we're talking about cryptocurrencies here, but the author is very, very specific about how they view these assets.
Oh, absolutely.
Because they aren't talking about day trading tokens to get rich quick.
No, not at all. And that distinction is crucial to their roadmap. The text really goes out of its way to position self-sovereign assets not as speculative investments, but as functional lifeboats for economic survival.
Lifeboats.
Yeah, they are tools of preservation, not speculation.
So what does this all mean practically? Like, how does a piece of code acting as a lifeboat actually stop a government smart contract designed to freeze your bank account?
Well, it comes down to the technical architecture of peer-to-peer networks.
Okay, break that down for us.
A truly decentralized blockchain operates entirely outside the reach of centralized kill switches.
Because it's not on one server.
Right. The ledger isn't hosted on a server owned by a central bank or some corporation. It's distributed globally among thousands of independent computers or nodes.
So there's no single point of failure.
Exactly. There is no central server for a government to subpoena or shut down. And there's no central authority that can code a geofence into the base layer.
The protocol itself is neutral.
Yes. It brings us back to that neutral value layer we lost when physical cash disappeared.
Okay, but how do I actually hold this neutral value?
The text emphasizes that the security of these lifeboats relies on holding the private keys.
Private keys.
A private key is essentially a complex cryptographic password. If you hold the private keys to a decentralized asset, you hold the mathematical proof of ownership.
And nobody else does.
Right. No automated smart contract from a central bank can confiscate or freeze those funds because the underlying math of the blockchain physically prevents the funds from moving without that specific cryptographic signature.
Okay, but the author provides a very specific roadmap for executing this sovereign exit, and honestly, it sounds incredibly daunting for the average person.
It is definitely a high barrier to entry.
They state we must transition from centralized exchanges to non-custodial storage.
Right.
Which, to use an analogy, it's like if you buy decentralized assets and leave them on a corporate exchange app, like on your phone,
Yeah.
it's like keeping your gold in a bank vault.
That's a perfect way to look at it.
Right. The manager can still just lock the door on you when the government calls.
They absolutely will.
So non-custodial storage is essentially taking that gold out of the vault and burying it in your digital backyard, where only you have the map.
Precisely. And the roadmap frames non-custodial storage as a mandatory evolution. You have to do it.
Because the corporate exchanges will comply with the government.
Right. The author assumes that corporate centralized exchanges are heavily regulated entities. They're subject to the same laws and smart contracts as legacy banks.
So if the permission layer demands your assets be frozen, the exchange will just hand them over.
Exactly. Therefore, you, and only you, must possess the private keys.
But the roadmap doesn't stop at just holding your own keys, does it?
No, it goes further.
The text details the necessity of using privacy-preserving protocols to mask transaction metadata.
Yes.
Why is that step necessary if the decentralized wallet itself can't be frozen? Like, if my funds are safe, why do I need to hide the metadata?
Because the author anticipates that central authorities will deploy highly sophisticated tracking AI.
Tracking AI.
Yeah. Even on a decentralized network, the ledger of transactions is often completely public.
Oh, right. Anyone can view it.
Exactly. So the AI will monitor these public ledgers to map out social connections, trace funds, and identify dissenters.
Oh, I see. So even if the central bank can't technically confiscate the digital coins in my self-hosted wallet, the AI can still see exactly who I am transacting with.
Right. They could identify your wallet address, figure out it belongs to you, and then punish you in the legacy financial system.
Oh, wow. So they might not touch my crypto, but they could revoke my physical passport.
Or throttle your CBDC grocery allowance like we talked about earlier.
That's wild.
Therefore, the roadmap instructs the reader to utilize specific cryptographic protocols that mask the metadata of a transaction.
So it hides the sender, the receiver, and the amount.
Yes, this effectively blinds the tracking AI. And really, the author is advising readers to build an entirely separate parallel economic identity.
A parallel economic identity. I mean, that is a massive behavioral shift for anyone.
It is huge.
Building a parallel economic identity means prioritizing deep, long-term security over the sheer convenience of traditional banking. Or, just tapping a card at a coffee shop.
Right. You're sacrificing convenience for sovereignty.
It sounds like a really deliberate, technically demanding process of just hardening your personal sovereignty against a system designed to monitor everything.
It is a profound manifesto outlining a highly defensive posture. The author firmly believes that participating in the legacy system will soon require sacrificing all financial privacy and autonomy.
All of it. Well, to bring our journey through the sovereign exit into focus here, we started with the author's core assertion that the upcoming 2026 retail CBDC rollout effectively killed the neutrality of money.
Right. It replaced the anonymous freedom of physical cash with what they call a conditional license to spend.
And then we examined the mechanics of how that conditional license is enforced, right? Through the invisible walls of algorithmic ledgers.
We looked at geofencing, which locks your spending to certain zip codes.
And use it or lose it expiration dates, which basically destroy the ability to save and force artificial consumption.
Then we explored the really terrifying potential of the permission layer,
where your digital identity is completely married to programmable money,
allowing for the automated instant freezing of assets for social or political noncompliance with zero human due process.
And finally, we unpack the author's roadmap for survival, the sovereign exit.
Utilizing decentralized, self-sovereign assets as untouchable lifeboats.
Mastering non-custodial storage so only you hold the keys.
And employing privacy protocols to build a parallel economic identity safe from AI surveillance.
So for those of you listening, whether you agree with the author's stark political warnings or whether you think this whole scenario is overly dystopian,
And a lot of people will think it's overly dystopian.
they definitely will. But the underlying technology of money is undeniably shifting right now.
Absolutely. The mechanics of programmable money are very real.
They are. And the debates surrounding self-sovereign assets are happening right now at the highest levels of global finance.
They really are.
Understanding these concepts, truly grasping the mechanical difference between money as a bearer instrument and money as a conditional license, it is absolutely crucial for anyone trying to navigate the future of their own financial autonomy in an increasingly digital world.
Because the transition from physical value to programmable value changes the fundamental relationship between the citizen and the state. That is the core reality this text forces us to confront.
It certainly is. And as we wrap up today's deep dive, I want to leave you with one final thought to mull over, something that kind of pushes the author's premise even further.
Okay, let's hear it.
So the text positions decentralized assets and private keys as the ultimate untouchable lifeboat against a system of algorithmic social compliance, right?
Right.
But if programmable money is ultimately used to enforce behavior, what happens when the central authority decides that simply holding a decentralized private key is, in itself, a metric of non-compliance? Yeah, if the lifeboat becomes illegal to own, does it still float?